Nobody expects the Fed to move, but Treasury yields have been pricing in more cuts. The Federal Reserve sets rates today, but its own projections don't see a rate cut until most likely June. Amid the tech sell-off earlier this week, though, short-term Treasury yields lost ground as Fed futures markets moved to price in 2 rate cuts for this year rather than 1. Tim Graf is head of macro strategy at State Street. Tim, what are you expecting?
Well, as you say, there's not much expectation for any move this meeting or indeed future meetings, and that's our central expectation. I think what we might have that's interesting to say is that, as you mentioned, the first cut, or the next cut, I should say, is expected in June. We don't actually see that as likely until maybe in September. The reason for that is you probably need at least a few more months of data on inflation to confirm that it's resuming the path towards 2%. And to my mind, it's not likely we'll get that confirmation in as strong a form as maybe the Fed needs to be comfortable easing again until probably May at the earliest. And then they always like a period of messaging what's coming. So that does put June in play, but in our view, it's still more likely to come a little bit later, maybe September.
What's happening in the Treasury market then? Are traders becoming less nervous about inflation under Trump?
Well, there's a couple of things. So you had a more benign print on inflation last month. That was what really started this whole move that you alluded to in the introduction. I think there has been some relief that there were no day one tariffs from the Trump administration. That certainly was being priced in some probability, and the fact that that wasn't delivered was certainly good news for Treasury markets. And then most recently, you've had the volatility in equity markets, which has brought back the kind of more traditional correlation between stocks and bonds that we were used to maybe the preceding 20-25 years, where when stocks go down, bonds go up, and you had the potential for a kind of risk-off flight to quality, and that was also contributing to the move lower in yields.
We also hear tomorrow, Tim, from the ECB, where a cut is fully priced in. There's been a lot of negativity around Europe's economy recently. Christine Lagarde said herself in Davos that Europe might be facing an existential crisis. What sort of commentary are you expecting from her?
Yeah, I'll be watching with a lot of interest as far as the future path of rates. As much as the Fed is a lock to pretty much do nothing, the market is pricing the ECB to almost certainly cut rates at this meeting. So that's not new news. The things to watch for will be how programmatic that she might talk about future rate cuts being. That's really a signal that they could be going every meeting where, it looks like the Fed is starting to skip meetings, take long extended pauses. The ECB doesn't really look to be in any danger of doing that. And my curiosity will be whether this is a continuation of the cut every meeting path that we've been underway, that has been underway for the last few meetings. I suspect it is. I think we'll probably get a cut at every meeting for the next, say, 4 or 5 meetings after this one, which isn't priced by markets. So I suspect that is still to come.
As you say, that's not priced in, but do you think policymakers feel the need for growth is so urgent they're going to be much more aggressive?
I think so, because you will have inflation in the Eurozone in particular, I think, getting back towards target. It is very sticky. It's a little like the US situation where it's stickily above target. But as you mentioned, the growth outlook is that much more dire. You see this quite clearly in the German numbers, particularly in industrial production. Europe as a whole is a globally sensitive economy, and so weak demand to the places Europe exports to, i.e. China, is also weighing right now, which again is a very different situation than what's being experienced in the US. So I think it does argue for that easier policy trajectory.
Of course, Tim, the Bank of England is up next week and faces a similar dilemma. How much more aggressive do you think they'll be willing to be?
Yeah, as much as I think Europe isn't fully priced for rate cuts, I especially think that's the case for the Bank of England. And you're already starting to hear some soundings on this with the willingness to embrace more rate cuts this year or doing so at a higher frequency. You do, I think, have a bit more of a dovish tilt to the MPC voting members. So I would expect where, as I say, another 4 or 5 cuts from the ECB this year, I think you can certainly match that in the Bank of England. And I think only about half, maybe 60% of that is priced by rate markets. And so I would look for that outcome over the coming months as well, particularly as you continue to see labor market data from the UK stalling. You already have inflation making progress back towards target, and a lot of the kind of big one-off boosts to inflation that came last year are going to roll out of the calculations. And so I suspect they'll be in a good spot to ramp up the progression of rate cuts in the next couple of months.
That was Tim Graf of State Street. Don't forget, you can watch more videos on Reuters.com.